G'day guys, welcome back to the Devon Too Good Investing channel, and today in this video I'm going to show you how you can value businesses just like Warren Buffett and all the other great value investors. Now, the method of valuation that I'll be teaching you in this video is the discounted cash flow method. And what this method involves is entering a free cash flow number that the business is producing and then growing that free cash flow number out over the next, let's say 5 years or 10 years, and then discounting it back at the appropriate discount rate to then provide us with a buy price that we'd be willing to pay to achieve a satisfactory return. So today in this video, we're going to go over that exact process I just described, but for the company Alibaba, ticker symbol BABA. Now, before we do this and fill in these parameters here, let's discuss what these parameters are. So the first parameter we're going to be entering into our discounted cash flow model here is going to be our growth values. Now, we're going to select 5 different growth values that we expect Alibaba could achieve over the next 5 years. Then following that, in this column here, we're going to enter our 3 cash flow value for the previous year. This is what we're going to grow out into the future. Then down here, I've already entered in the required growth rate of 22%. Now what this assumes is that we want to achieve at least a 15% growth rate per year, because if we don't achieve 15% per year, we might as well just invest our money into an index fund. So why have I put 22% instead of 15%? Well, I want to incorporate a margin of safety into the model. Now, the basic logic behind this is that if we are wrong, then we're all good and we should still achieve 15%. Now, why 15% though? Well, 15% is a double of our money in 5 years. And then over 10 years, it will be a 4x of our money. But over 10 years using a 22% rate of return, that's 8 times our money. So effectively, it pretty much gives us a 50% margin of safety using a 22% discount rate. Then after that, we need the shares outstanding of the company. I'll show you how to find that. And then following that, we also need a terminal multiple and net cash of the company. So now let's work out what price we want to buy Alibaba. So the first thing we're going to do is enter our growth rates as discussed before. I believe that anywhere between, let's say, 16 all the way down to 20% growth per year is pretty reasonable for Alibaba. Now what we need is our 3 cash flow from the previous year. And we can get this by having a look at Alibaba's earnings from the previous year. So as we can see, year ended March 31st, 2021, Alibaba produced 26.353 billion US dollars. So what we're going to do is we're going to go enter that into our little box here. So it was 26353, and then we can drag that down like that so it goes across each model. And then the next thing we need is our shares outstanding. This can be grabbed from going into Yahoo Finance. You can enter the ticker symbol into here just like that, and you will see that Alibaba has shares outstanding of 2.71 billion. So if we go back to our model, we can enter this in. This, instead of billions, we're going to put it in as millions. So there's 2,711 millions within 2.7 billion. And then we're going to need a terminal multiple. Now, how do we get that? Well, usually the best way to get a terminal multiple is to use a price to free cash flow ratio. And as we can see, ever since about 2015, Alibaba on average has traded between a 20 and a 30 free cash flow multiple. We have seen it go above this 30 before, back in 2017, and it got all the way up to 38. And as we can see now, it is trading at about a price to free cash flow ratio of about 14, which is well below its historical average. For the sake of this valuation, I think a price to free cash flow ratio of about 20 is fair. So we'll add 20 into here. Maybe you might want to make it 15 if you want to be more conservative. And then finally, we need a net cash. So if we jump back over to Yahoo Finance, we can see that Alibaba's net cash is listed here, and the total cash is listed here, and the total debt is listed here. So what we want to do is we want to minus one from the other. So let's do it right now. So that gives us 302 billion renminbi. So we're going to have to convert this to USD. So if we go and we enter 302, so that gives us 46.6 billion. So let's go back to our model. And we'll go 46.3, so 46 billion, and we convert that into millions. So now we have entered all our parameters into our discounted cash flow model. We have now been given a buy price. This includes our net cash value over here of between $182 all the way up to $210. So what this means is, if Alibaba can grow its free cash flow by 20% for the next 5 years and then sell at a price to free cash flow multiple of 20, and if you buy it at $210, that means you will get your 22% return per year. Same thing could be said for your $182. All the free cash flow would have to grow by 16% per year and sell back to the market at a terminal multiple of 20, and that would also return you your 22% per year. Now, according to this model, Alibaba does look cheap right now. It is trading at $173 per share at the moment. So this would imply, I'd say, around about a 15% growth rate going into the next 5 years, which I think is quite low for Alibaba. I've got a feeling it will achieve more than 15% per year. But also, who knows? Wonder if it will get multiple expansion. I would say it would probably trend back to its sort of average between 20 and 30. If and when maybe the tensions between US and China sort of calm down. But if that doesn't happen, maybe we get a terminal multiple of 15, and you can see that this changes our buy price ranges from $150 to $173, which pretty much perfectly lines up with Alibaba's current stock price if you believe Alibaba will grow at 20% per year. So guys, I hope you enjoyed this video. I hope you learned something, and make sure you subscribe, like this video, all of this and that. Have a good day.